One last look at the disclaimer. All right, you want to share your screen?
Yeah.
And Tiffany is on.
Oh,
She's
Tiffany.
already she's
Okay.
already announced to the chameleons that this was her
Okay.
question. So thanks, Tiffany, for the question.
Yeah. Yeah. Thanks, Tiffany, for the question. And so the question dealt with, just go over the question really quickly, and I'm trying to summarize it from memory in the email. If I have an option that trying to track a theoretical value, what would it look like if the stock started moving the following day? So if you did the option today, or you did an option strategy today, and you're curious what happens to that option in theory or strategy in theory the following day as the stock moves up or the stock moves down. Okay. Um, so let's first pick a stock here, just out of curiosity, one that's reporting earnings, because that would be an interesting thing, I think, to uh, put into a simulation. Well, here's an option, and this is where the option is right now. And let's say that there's going to be an earnings uh, after the market close, and I want to see, well, how does that option look like the next day based on different stock prices, where if the stock moves up, the stock moves down. Um, so I'm going to pick a stock from our earnings calendar. Okay. And here, these are the expected earnings today. And let's just go. Here's the one on the top of the list is Costco. It's going to report earnings today after the market closes. Okay. So let's go to the options chain, look at a particular option or strategy, and then we're going to run our uh, simulation based on, and we're going to change a few different risk parameters, okay, because the options have sensitivities uh, other than just delta directionals. So let's go to Costco, COST, and I'm going to go to the options chain here. And these are the option prices for yesterday's close. We're not open yet. So we're looking at yesterday's uh, end of day options chain. We're defaulted right now to May 31st expiration. So these options will expire tomorrow. Okay. And you could see here, this little E is telling us that there's going to be an earnings that covers this expiration, which is today after the market close. And let's take a look at a option strategy. Let's say we want to do an option strategy and we're interested in the straddle. Okay, so the straddle is buying the call and the put, right? So if we do where's the stock price? 86.52. So let's just do the closest one. Let's just do the 807.50. Okay. So the straddle, we're going to do it from the long side. We're going to start out with the call. So I'm going to click on this ask uh, uh, price on the call. So what it does is brings up a buy May 31st, 807.5 call for $6.85, because that's where the price of the option is that I clicked on. You can change this, but let's leave it at that. And then let's do buying the put, 807.5. So then I'm going to click on the offer and a put. And now it brought up buy May 31st put 807.5 for 1710. And then we're going to run the analysis. So this is a strategy. We're doing both options, and this is going to take into consideration both options. If we wanted to do one option, we'd do just one, but let's do both for this example. And then if you want a different example, let me know. So I'm going to run this analysis, and I get these these summary stats, but right now I'm going to skip this and go to the risk sensitivity of this strategy. Okay, so here we go. We're a long straddle, and we're going to go to this pricing and risk sensitivity. All right. So what do we have here? Let me close this to expand the screen. What we have here is what is the profit and loss of this strategy as the stock moves up and down. So here's this current stock price, right? And the stock could move up, it could move down. And the initial graph shows if nothing else changes, we have no time decay right now. We have the implied volatility stay exactly the same. None of the other factors, right, that play into these options changes. Only the stock price, the delta. What does this P&L look like? So here we go. So if we start at 0, if the stock does not move, this is telling us, well, then based on the mark to market, you're down $72.40. Why is that? Well, keep in mind, if we paid the offer, let's go back here. I'm going to come back here. Well, if we paid this $33.95, if we paid the offer, the options get marked to market, right? So where would they get marked? They'd get marked at the midpoint. So if you paid above the midpoint, right, but the options get marked at the midpoint, it's going to show up as a loss on your account. That's how the options are marked to market. Okay. So if it's 0 and this is the price that we paid and this is the mark to market, it will show up as initially a loss because, you know, we didn't try to get a better execution. This is where it would based on that analysis. So if the market moves up and there's no decay, you could see up 1%, up 2%, up 3%. This is the straddle. The more it moves away from that stock price, the more profitable it is, right? On the way down, this is down to, and you could hover over as so, okay, to get those P&Ls. So that's based on the delta. That's just based on the options delta and gamma. So what does delta and gamma mean? Well, the options has a delta, but the delta is not constant. It has a gamma. So as it's moving and moving, right, the delta, as the option becomes more and more in the money, the delta increases until it gets to 1. Right. So if you start out at a 0 delta, an option way out of the money, as it gets closer and closer to that, the delta increases, and it could increase all the way up to a 1 delta, which means it'll move 1 for 1 with the stock. A 1 delta, 100 delta means it's moving 1 for 1 with the stock, but you know but the deltas could be anywhere between 0 and 1, and on the put between 0 and -1. So this is what it would look like today. That's today without any decay. What if we wanted to see tomorrow? Well, if we're going to go 1 day ahead, well, what do we have then? Well, we know that the options are going to decay. That's at least if the implied volatility stays the same, then one of the factors is the time decay. We got one day closer to expiration. So let's check that out. What if, you know, the stock doesn't move today? What if we don't expect it to move today, but we expect it to move tomorrow? You know, let's see what that looks like. That will factor in the time decay. Now, this option here, keep in mind, here's days to expiration. So there's only 2 days to expiration. So that's going to have a huge time decay, right? As you get closer to expiration, the time decay is greater. Time decay isn't linear. So let's move it up one day. I'm going to click on this, and we want to see what that looks like. Well, actually, this is May 30th. Sorry. So keep in mind, this is as of close yesterday. So let's see what it looks like today if just the option is the case. So I'm going to click on that. So what did it do? Before I run the analysis, you could see now it's looking at this strategy with 1 day to expiration. So you see what I did? I reduced this by 1 day. Days to expiration. I reduced it by 1 day before I run the analysis. And I want to compare it. I want to compare what is it today versus the next day. Right? So here's the initial strategy, 33.95. This is the cost. This is the delta, the gamma, the vega. These are my risk sensitivities. The delta is the sensitivity of the strategy based on the stock movement. The gamma is what the delta will change by for every dollar move in the stock. The vega is the sensitivity to the implied volatility. This is my theta, how much they have decay, my rho, risk to the interest rate. So let's run this analysis right now. I've reduced it by a day, right? 1 day decay. I'm going to run this analysis, run. Okay, now I have May 30th. So what happens is that if the implied volatility does not move today, it's exactly what it was as yesterday. If the stock doesn't move today at all, and it's at the same price, right? Then what happens is that this will be the new value of the option, the strategy. It will decay. It'll go from 33.95 that we paid. It'll be worth 23.51. This is the new delta, gamma, vega. And here's the chart comparison. So here, if we start out at 0, you can see that there'll be a loss of $1,044. Now, the implied volatility will probably go up today to compensate because it's pricing in a gap move, right? So we'll see that that gap move will remain priced into those options because the earnings are still coming out. But let's say it didn't. Let's say the implied volatility stayed the same. Well, you could see here that even if the price went up 1%, that's not enough, because the decay would still exceed any gain from the delta. 2%, 3%, you would have to look at a 4% move to basically offset the decay by the gain in the option due to its delta. All right, and 4% move to the downside. So here's a comparison. That yellow line is where we closed yesterday. And if the stock moved, now the blue line is taken in 1 more days of decay. So you could see where the decay, it dropped the line. We're long the options, so the line dropped because that decay is reducing the option prices, right, and resulting in a loss. Let's do another day. Let's do it. Well, actually, we can't because this one I think will go right to expiration. But let's say that we have another issue here. Let's say that the earnings were today. Well, the implied volatility is not expected to stay the same, right? It's not just the decay now that we have at risk. It's the implied volatility. That risk premium of the unknown will get taken out, right? The risk premium for the unknown is the earnings release. We don't know what the earnings are going to be yet, so there's a big risk premium priced in. But then once that earnings release comes out, the stock's going to move. Everybody knows what the earnings are. They have a chance to dissect it. They'll listen to management's comments, whatever. Then that uncertainty gets removed, and the implied volatility will come back to a more normal level. So where's that level? We don't know exactly. We could look at historical values to see how much gets sucked out, but let's just use some reference prices here. I'm going to come up here, and here's IV versus historical, right? So we could just look at these numbers and say, okay, the last 20 days, the stock moved at a 17.9 vol. In the last year, the stock moved at a 16.1 vol. If we took the averages, we got 16.3 versus 19.3. These are the high and low. So let's just say it's going to revert somewhere between 16 and 17, right? Let's test that out. We don't know for sure, but we're just testing it out. So I'm going to come back down here and say, okay, so far, here's the implied volatility. 58.5, 57. Obviously, that's because of earnings. But what if I said tomorrow, all this is going to go to 17? I'm going to just type it in instead of like scrolling down. So I'm going to type in 17 on the call, 17 on the put. So you could see here, I just decreased the implied vol by 41 on each one. So what are the changes I made? 1 days of decay. Obviously, we forwarded, and we removed the implied volatility. Now we said the implied vol is going to be lower. Okay, let's run that analysis and see what the graph looks like going up and down now. So I'm going to run that analysis. Run. Okay, so you could see that with the stock unchanged, right? With the stock unchanged, and if we I changed these parameters, if the stock's unchanged, that the value of this strategy is all of a sudden $6.93. So today, it would be worth almost $7 from $33.95 to almost $7. Okay, you can see the delta, the gamma, all this change. So this is where we're at here. It goes from here to here, right? With the stock, that means their earnings came out, nothing happened. The stock's exactly where it is right now, and the implied volatilities came out. So this is what it would look like. These options, this straddle would lose $2,700, right? If you did one contract on each. And it would have to, for that straddle, given those circumstances, for that straddle to become profitable, it would have to move by a big enough percentage. So where is that? So we could see here, we're at the 5% on each side already, right? So even at 4%, it's not enough. At 4%, given the time decay and the implied volatility crush, we're still looking at, a loss on these ends based on these changes, right? The theoretical changes that I'm putting in. And we could play around with it. I could reduce it by 30. I could reduce it by 45. But this allows me to run the scenarios on, different situations and test out, okay, how much does the stock have to move? Where does it have to go to? And then I could decide how realistic that is. But this gives me a potential risk and reward of the strategy. So here it looks like, you need about a 5% move at least, or around a 5% move to hit your profit areas. Other than that, you're looking at that blue line here. Okay. And that blue line is showing you how far away. It's comparing it to just today's. This is where it would have to move today, the yellow line, with no changes to time decay or IV. And then I took out the time decay and I took out implied volatility. And now I have a visual for comparison. Okay. So, hopefully that was helpful answering that question. You could do that, setting up your own strategies and run the analysis.
Well, awesome job. Tiffany already said it was super helpful. So thank you. Great job, my friend, as always. Have a great day.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day. And hope to see you guys tomorrow.